Welcome to today's special panel presentation focused on the economic impact of COVID-19 on structural engineers. My name is Al Spada, and I'm the Executive Director of NCSEA. This panel is a joint effort between the Structural Engineers Association of Illinois and NCSEA, and is being provided at no cost as a benefit of your membership with these two organizations. On behalf of SEAOI and NCSEA, I would like to thank you for your support. Before we begin the presentation, I have a few announcements for you. First, the webinar is being recorded and will be placed on the NCSEA website. Second, when you have a question for the presenters, please type it into the Q&A box on your screen. The presenters will address the questions at the end of their presentation. I will now turn the microphone over to former SEAOI and NCSEA President and today's moderator, Bill Bast, to begin the presentation.
Al, thank you, and good morning or good afternoon, everyone, and welcome to our panel and discussion. I will be introducing each of the panelists, and then they will each present their 15 or so minute presentation. And at the end of the three presentations, we'll take questions and answers from the audience. I'd like to introduce the first presenter now, Andrew Updike. He is a member of the economics team at First Trust Portfolios, a financial firm based in Wheaton, Illinois, that Barron's has ranked as the #1 U.S. equity fund family in both 2018 and 2019. His team has been consistently ranked by Bloomberg as among the most accurate forecasters on the U.S. economy. And financial advisors across the country voted his team's commentary on the markets and economy as the most read and most shared research they receive. Andrew has earned his MBA from Northwestern University's Kellogg School of Management, and he's a chartered financial analyst charter holder and also a member of the CFA Society of Chicago. Andrew, welcome. We look forward to your presentation.
Bill, thank you so much, and greetings to everyone. Welcome to today's conversation. I'm really looking forward to this. I'm going to talk a little bit first, then we've got John and Kevin, and if you haven't heard them talk, I think you're in for a treat today. So I want to start things off and kind of look at what we're seeing from an economic perspective, try to put some numbers into context, and do a little comparison in terms of what we're seeing so far and kind of where we think we may be heading. And I want to start from the highest level. Let's start with GDP. This is the output of the country as a whole. Okay, and as you can see on this chart, this is looking at the impact on GDP, the growth of GDP that we've seen over time in the post-World War II era. And at the beginning of this year, January and February, the economy was growing at about a 3.1% annualized rate. Now, that was through January and through February. And 3.1% from an economic standpoint, to put that number in perspective, if we had grown 3.1% across the year, that would have been the fastest year for economic growth since 2005, before the Great Recession, the financial crisis, that housing crisis. But we had that impact. We saw the coronavirus come here to the United States. We saw large swaths of the economy shut down. And we've been living this now for 2.5, 3 months. Well, the impact in March, the first quarter, January, February, March, despite that fast growth through January and February, the impact in March is that the first quarter ended up seeing a -5% decline. And as you can see, this orange line, as we look at the second quarter, which is April, May, June, and April, right? April was the period in time where the largest portion of the economy, 90+% of the country, was in shutdown. That was the month where we saw the deepest, most severe economic impact, where we saw things start to open up as we went into May. Activity started to return, but we're still below the levels that we were in January and February of the year. So we look at these numbers, And we ask, have we ever seen something like this before? And in the post-World War II era, we really kind of haven't. The only time we really have for some comparison in terms of a double-digit decline is back here in 1958. In 1958, it's a good point to look at as well from an economic standpoint, because back then in 1958, we were also facing a pandemic. 1958, that was the Asian flu. It killed 116,000 people in the United States. It killed over 1 million internationally. It was tragic, as is the impact of COVID. But one thing that we've seen historically, when we've had 1958 or in 1968 when we had the Hong Kong flu, when we've seen pandemics in the past, we do tend to see a severe decline in activity, but it tends to be short. Unlike periods like, let's say, 08, 09, or the recession that we had in the early 1980s, where we had a fundamental recession, where it was multiple quarters, 4, 5, 6, 7 quarters, to get through the fundamental issues that were underlying that slowdown in economic growth, to get that reset, to get back towards growth. What we've seen from pandemics is that you see a sharp downturn, but then if you look at the activity as you emerge, it tends to rebound quicker. Now, the slowdown, it didn't just impact GDP. Well, the GDP impact, right, that comes in large part because we've had a decline in the number of people working. In March and April, we saw 20.7 million jobs lost. And looking at that and comparing it to 08, 09, which we all remember, a painful period in time, but remember, that was January 08 through February 2010. This was 25 months from when the jobs peaked till when they bottomed. We saw a twice as large decline over the span of 2 months, severe, but again, short. We actually saw in the report we got last Friday that jobs have started to turn, that jobs are starting to come back. Now, that historically has been a signal of the bottoming from an economic perspective. It appears that the economy bottomed in May, and that here in June, we are in the recovery stage of this recession. But while I look at these jobs, it's important to remember, and we know this again, in particular, this conversation today, if we go back to 08, 09, and even a little bit before that, we know recessions impact different groups in different ways, right? If we look back at what happened back in 2008 and 2009, remember residential construction, home building, even non-residential construction, right? The residential, it started to move earlier. It started in April of 2006, and it continued longer than the general downturn. Over the time period in 08, 09, the residential construction industry lost around 46% of the employees that were there at the peak back in April 2006. On the non-residential side, we saw job losses of 24%. That decline in here, and that was during a time period when the overall private sector job loss for the nation was around 7%. So the impact in 08, 09 on both the residential and non-residential construction fields was in far excess to what we were seeing generally in the economy. It was a very hard-hit sector, and we saw that longer recovery time. In fact, on the non-residential side, from non-residential construction, February of this year, right before things turned, that is when we hit a new high in non-residential construction employment. We hit it in February 2020, and then things turned. Now, the turn down, residential, non-residential, this time around, they declined between 10 and 15%. So around on the non-residential side, half the percentage decline in employment. On the residential side, it was about a third, and we've already started to see some of those recoveries. The job gains, as we look at what happened in the month of May, for example, over March and April, residential construction lost 124,000 employees, 65.6 returned in the month of May. So while it bottomed 14.8% job decline, now we're closer to 7%. The turnaround, it's going to take a little bit of time to get back to where we were when it started, but the magnitude of the decline was smaller this time around, and the length of time it took to get to that reset period. As we look around at the world around us, as we think about businesses across industries and how they were impacted by COVID and how they continue to be impacted, we notice how different this is from some of the past recessions that we've had, periods where there was a fundamental issue that was in place. This time around, these businesses, they're not closed because they had a bad product, or they're not closed because they had bad services. Their employees that were let go are not home because they were poor workers. This was a government-induced shutdown for health and safety reasons. And as we start this emergence process, I'll talk more about that in just a minute, but as we start that emergence process, well, it was swift in the decline. I expect will be a little bit swifter in the recovery. Now, industries are being impacted here in different ways. On the residential side, when we consider the path for home building, we look at the fundamentals, the dynamics behind it. And housing starts, they tend to, over time, average growth based on the expansion of the population and the natural scrappage, the deterioration of homes. Over time, based on where we stand from a population standpoint, that's averaged about 1.5 million units per year. Now, we had overbuilt before the housing crisis, and it took a little while to get through some of the excess stock, and we were actually just getting back towards this level at the end of last year, the beginning of this year. But we had a period in here where we had we had caught back up on the overbuilding that had taken place before the downturn, and we reached a point where now we needed to ramp up activity. Housing starts, and we're already seeing comments from some of the home builders, like Toll Brothers, where in their earnings calls they're saying, well, we're seeing this pick up back in activity. And it's looking more like it did in February and March than it did in April and May, because there's demand for the housing. I expect that the residential construction is going to return quicker than many other areas of the economy. Now, on the non-residential, as we think about commercial, there's some complicating factors. One of those is this general shift that we've been seeing for a while now towards non-store retailers. Right? It's not a new thing. It's a trend. It's been moving, and non-store retail growth has been moving faster than general merchandise stores, which includes the big box stores, the Costco's, the Sam's Clubs. And what we saw, we did see this little blip. We see that movement higher in general merchandise stores that before the downturn. That was people stockpiling. Remember the great toilet paper run of 2020? We had that taking place preparing for COVID. Now, as the world has moved from the outside inside and the inside online, and we haven't been seeing the same level of activity at stores. People have still, in many cases, continue to shop. We've seen that rise in non-store retailers. I'm not expecting that the pace that we've seen kind of over the last month or two, that we're going to continue to see that pace, but I do expect that this general trend towards online sales is going to continue. Now, we're seeing something similar also from the business investment standpoint. If we look at where businesses have been investing, they've had this general shift over recent decades away from structures and towards software. Now, part of that is the types of industries, the types of companies that have been rising, that have been growing faster and have been spending more money. But this, too, is a trend, and this is something that we're going to need to think about and consider the impact and the recovery pace for some of the non-residential construction. Now, as I look at this and as I look back in history, and I think about from prior recessions, how does an economy recover? How do we kind of determine or get an idea of which sectors look likely to recover quicker? Well, one thing we see is that historically, the sectors that are at the center of a downturn, they tend to have more focus, more investment emerging. We don't want to be in a situation where the next downturn, the next recession, looks like the last recession. This time around, unlike what we saw back in 08-09, back then we looked at the banks, and we saw activity there. This time around, it's the cures. Healthcare, we're seeing it. We're seeing a pickup in activity in pharmaceuticals, things like biotechnology. The hospitals are increasing their spending on hospital response systems, on expanding ICU and doing some construction related to modifying facilities to be prepared for what may see a second wave or another pickup in a virus in the future. The healthcare sector, that industry, is going to return back towards investment, return back towards employment, return back towards growth faster than some other areas. Likewise, as again, we've moved from the outside inside and inside online, it's put additional strains on our communications infrastructure. We've seen companies putting an increased investment in cloud computing, which necessitates server structures. We're seeing this movement and this preparation that's going to see some communications-related infrastructure building, I believe, move faster, quicker through recovery. Now, there's other sides. There's areas like energy, where not only do they have COVID, they had the issue with the Saudi Arabia and Russia kind of oil fight that we got involved with. That imbalance will take a little bit more time to even out. And right now, what they're doing is they're shutting down wells. They may see a more prolonged decline in construction activity. Airlines took a hit. The leisure and hospitality and the transportation sector in general saw an impact. That too may take a little bit longer to play out. And another area where we see kind of maybe a longer headwind ahead of them is education. In particular, secondary education, as we look towards the fall. And families, students, both here and internationally, need to look at, are we sending our kid to out of state? Are we sending our students from China, from India, from France and Spain, who so often come here? They pay full tuition, which is an important part for the educational institutions for their budgets. There's a question of, are they going to send them this year? Because we don't know yet whether all those classes, some of them are going to take place online. Well, if you're going to be doing it online anyways, are you going to pay the room and board? Are you going to take those costs in the short term with that unpredictability? And if we do see a rise in the fall or going into the winter and we're going to be sending students back home again, this is going to be a serious consideration, and it's going to provide some uncertainty on the educational side as they think about their spending. So pharmaceuticals, biotechnology, we're going to be bringing some of those back from international. I think we're going to see that increased spending, but there still remains areas of uncertainty. Now, as I think about that second wave, that's one of the major questions from an economic perspective, because we've started now, we're in that economic recovery period. But everybody is watching, not just here, they're watching internationally to see, do we see a pickup in cases? If you've been watching the news, you've seen there's been some reports out of Arizona and out of Texas that they've seen some higher rates, Florida as well. But here's one thing that I want to remind you, and this is the last piece that I kind of want to touch on, is that well, we saw the number of new cases peaking kind of back here in late April. The medical community did not stop. And the testing capacity, which is incredibly important. At the beginning, we said you need to identify and contain this virus. We didn't have identification back in the early stages. We started that ramp up. Even since we've seen the numbers peak, that activity has continued to accelerate. So now, as we start to see these second waves, we have capacity to test and identify in these areas. These next few weeks, this next month is going to be key to see how much our preparations towards the second wave, how well have we done? But I think we're far better prepared coming in now. We're far better set up, both the hospital system and the states as a whole, to be able to operate, to continue to reopen the states while still addressing any new rise in cases. In the meantime, what we're going to be watching, and this is the last slide, is what we're calling high-frequency data, because a lot of data, employment data, and GDP data, retail sales, construction data, we get operates with a lag, 4, 5, 6 weeks. We're going to watch the data on what's happening on a day-by-day, week-by-week basis. How many people are getting back out in the air? Down here, this is gasoline. How many people are getting back out on the roads? How much steel production are we seeing? Where is the demand for it? So we're going to continue to watch this data, which I think gives us hopefully a better pulse on that level of activity. We're expecting Q3 to be a faster growth period, a little initially looking V-shaped, but then I think kind of slowing off, almost like a check mark. but I'm interested to see what everyone else has to say. So I'm going to stop there, and I'm going to pass it back to Bill to introduce John. Thank you.
And thank you, Andrew. In 2018, John Cross retired as Vice President of the American Institute of Steel Construction, where as one of his responsibilities, he spent 18 years tracking and projecting design and construction activity in the United States. Since his retirement, he has continued to monitor construction markets and is currently writing a monthly column on construction trends that appears on the website of the Peddinghaus Corporation, the leading manufacturer of steel fabricating equipment in the United States. John received his bachelor's degree in civil engineering from Rose-Hulman Institute of Technology and also holds both a Master of Divinity degree and an MBA. He's been involved in the Chicago engineering community for nearly 50 years, during which time he served as Executive Vice President of STS Consultants and Regional Vice President of Bailing Consultants. Welcome, John.
Thank you very much, Bill. And I want to thank Andrew. That was a very helpful and insightful presentation. This afternoon, I want to focus on the design and construction sector of the economy. There's no question that we find ourselves in a unique time. None of the recessions any of us have personally experienced are identical to our current situation. But that doesn't mean that we can't take lessons from those earlier economic slowdowns and use them to better understand the challenges that we face today. We've experienced negative economic growth in the past, and what is clear is that design construction activity, the purple line on this chart is construction put in place, doesn't fall off as fast as the general economy at the beginning of a recession and picks up slower during the recovery. The design construction sector is different than other sectors. Our projects take longer to design, finance, permit, and build. We measure projects in months and years, not days and weeks. And because of that, we tend to lag the general economy. What we have seen in past recessions is that from the start of an economic downturn, design activity will be maintained for about a quarter before declining. Construction starts will decline 2 to 3 quarters after the start of the recession, and there will be a significant dip in construction put in place activity 4 to 6 quarters after the beginning phases of a recession. Coming out of a recession is different. Design activity will lag the initial upturn in overall economic activity by 3 to 4 quarters. Construction starts will lag 4 to 6 quarters, and after the economy turns around, construction put in place numbers will not show a marked improvement until 5 to 7 quarters after the end of the general recession. When we look at those numbers, what we see is that for the design and construction sector, the recession starts later, lasts longer, and ends later than what is occurring in the general economy. For us, the recession is stretched out. You may want to challenge me on that based on the recent news that the economy added over 2 million jobs in May, including 500,000 in construction jobs. I'll talk a little bit more about that later, but suffice it to say that what we had was a dead stop in the economy and then a restart, which in my opinion is hiding the actual recession that is occurring. But back to the question at hand, why do we get stretched out? Picture our portion of the economy as a circle divided into quarters. Each segment can be characterized by a simple supply and demand relationship, rents that are going up or down, and the occupancy level of buildings. The occupancy rate of a building is the flip side of the vacancy rate that we usually hear about. There are times when rents are going up while the occupancy rate is going up as well. Other times when both are going down, and often we are in a mixed environment. We can classify those conditions into 4 quadrants and identify them as expansion, oversupply, recession, and recovery. The building market moves through those quadrants in a clockwise manner. Leading up to the Great Recession in 2008, the building inventory was in an oversupply condition. Rents were still increasing, but the occupancy rate was declining. In 2019, we were teetering on the line between expansion and oversupply. A few segments, apartments for example, had entered into an oversupply, but the majority of the segments were just starting to reach that point. But now we've experienced a major shock to the economy that quickly reduced demand and accelerated design and construction into a recessionary period, creating a significant oversupply that will take a period of time, that stretch, to work through. The oversupply is not as great as 2008, but an oversupply nonetheless. Typically, design work accelerates towards the end of the recovery period, and construction work picks up early during the expansion. When will that take place? Coming out of past recessions, this typically occurs between the time when employment and economic activity return to pre-recession levels. It's important to note that I'm not talking about the unemployment rate, but the actual number of individuals that are working. I'm not minimizing the problems associated with unemployment. It is a serious issue that must be seriously addressed. But the economy is driven by the number of individuals that are employed. During the Great Recession, it took 24 quarters, 6 years, for employment to recover to pre-recession levels. How long will it take this time? The optimists among us will extrapolate the gains in May and see a return by the second quarter of 2021. The pessimists will see jobs added at the same rate as we averaged coming out of the Great Recession of about 200,000 per month, which will stretch us out to the second quarter of 2028. Reality is probably somewhere in between. This would be a rapid bounce back of jobs on hold in early 2020, but then a slower recovery of those jobs that have been permanently lost from business closings and changing consumer habits. These jobs and economic contraction is what I identify as the real recession, not the temporary constriction resulting from an imposed shutdown. The same is true of GDP levels. It took GDP 15 quarters to return to its level prior to the Great Recession. We don't know what the second quarter numbers will be, but a 15 to 20% drop in GDP is certainly not out of the range of possibility. And the third quarter will probably be a rapid rebound, encouraging some pundits and politicians to proclaim an end to the recession. And theoretically, they will be correct. But that doesn't mean that we will be back to pre-recession levels. How soon will that be? Optimists will probably say the first quarter of 2021. Pessimists, the first quarter of 2023. And realists, somewhere in between. For design and construction speculation about how long our downturn will last, that is somewhat meaningless, because none of us can know for sure. The optimists would see demand for design services picking up in the first quarter of next year. The pessimists not until the beginning of 2025. And the realists somewhere near the beginning of 2022. How will we know? We will need to observe the signposts along the way. Keep an eye on actual employment levels and GDP levels, but also keep an eye on the Architectural Billing Index published monthly by AIA. The ABI isn't based on the amount of billings decrease, actually, but rather shows the magnitude of swings in activity. AIA sends out their survey to members and asks, did your firm's billings go up by more than 5% last month, stay within a 5% range, or decrease by more than 5%? If that same number went up as down, the index would show a 50. In April, that ratio was 1 to 3. For every firm that had billings increase more than 5%, 3 had billings that decreased more than 5%. Over time, a consistent level in excess of 55 is a predictor of expansion in design activity. Another good signpost to keep an eye on is the Dodge Momentum Index, which tracks projects coming into Dodge's database in the conceptual stage. This is an early indicator of expanding interest on the part of owners for new projects and market expansion. So what type of projects will pick up first coming out of this recession? Until the Great Recession, it was typical single-family residential had led the design and construction industry out of a downturn. That did not occur in the Great Recession, but rather it was industrial, which is broader than just manufacturing, with some help from infrastructure stimulus, although that was limited by a narrow focus on the types of projects being funded, and a big push from renovation and rehabilitation. In 2020, industrial will not lead, primarily because of pullbacks in the energy and oil sectors resulting from oversupply and decreased demand, a recessionary driver in themselves. Single family may provide a push if there is a flight to the suburbs by young urbanites to escape high-density residential situations. Data centers and chip manufacturing will capitalize on the current online trends. Renovation and rehab will be a big push, with changes being made to buildings to address changing preferences and conditions. And there will be an accelerated growth in the warehouse segment. This will result from two factors. First, the growth in e-commerce during the pandemic has been significant. Much of that growth will stick, and the growth rate before the pandemic will be maintained. This is why Amazon has shown interest in acquiring the assets of JCPenney for use as warehouse space in urban and suburban areas. And second, companies like Fiat Chrysler that had to stop production of the Jeep Wrangler in early 2020 because one of the components of the steering assembly was only manufactured in Wuhan, China, and shipped to the U.S. with less than 1 month inventory buffer, will be rethinking their just-in-time philosophy by increasing inventory and expanding their supply chain. So how will the various construction sectors respond? I've been listening to a large number of webinars that are sector-specific and speaking with friends that work in those sectors. The combined knowledge of what I'm hearing from those sectors is presented in this chart in terms of what the immediate impact will be and at what rate the recovery will occur. There are no dates listed here. These results aren't analytical in the sense of some grand formula. They come from what individuals in those sectors are sensing about what they are seeing and hearing in their corner of the marketplace. Some are probably optimists, some are pessimists, and some are probably realists. So what should I expect as a structural engineering? During the Great Recession, the number of employed architects dropped by over 25%. Regretfully, the Bureau of Labor Statistics doesn't break out structural engineers from all other engineers, but there will be a pullback in employment and firm activity. This picture is one of my lasting images of the Great Recession impact on architectural employment. An unemployed Seattle architect set up a booth at a local farmer's market and answered questions for 5 cents each. His creativeness led to work as an independent architect and ultimately his own firm. I don't want to kid you. From my perspective, the next several quarters will be challenging and will require effort and creativeness on all of our parts. But again, we can learn the lessons of history. During the Great Recession, larger firms pursued smaller projects, particularly public projects such as schools. There was a strong emphasis on renovation and rehabilitation. Firms and individuals with specializations in a niche market did well, and relationships really mattered in terms of partnering together to approach projects. I believe the same will hold true in this recessionary period. I do write a column on economic trends, which is available on the Peddinghaus website, and I always appreciate hearing your perspectives on where our portion of the economy is headed. Thanks for this opportunity. Bill, back to you.
Thank you, John. I'd like to introduce the last speaker this afternoon or this morning, Kevin Ardell. He's the president and CEO of the American Council of Engineering Companies of Illinois, or ACEC, where he represents and advocates for over 200 engineering and affiliate companies representing over 11,000 employees. Prior to his current role at ACEC, Ardell served as Chief Operating Officer of the Illinois Tollway, where he helped manage and execute the Tollway's $14 billion Move Illinois capital program. As the Tollway's COO, Kevin coordinated with industry leadership Tollway policy and capital plans, emerging technologies, and best business practices. In addition to his work at the Illinois Tollway, Ardell served in senior roles for over 15 years in both the United States Senate and Illinois General Assembly. Kevin served as state director for former United States Senator Mark Kirk and as director of communications and later as the director of policy for former Illinois House Minority Leader Tom Cross. Prior to his work in government, Ardell served as director of government affairs for Amtrak. Kevin, take it away.
Thank you, Bill, and thank you to Al and Leo for all you do on behalf of the engineering industry. It's a great team out there, and we all work together to advance industry goals. So thank you, everyone. I'm going to focus a little bit more on the public sector side of the impact of COVID. So and run through some of the numbers that we're seeing on the public sector. So let's start out here in terms of national travel. And as I was preparing this deck, I was seeing the slides that were coming over from Andrew and John, and they were full of graphs, and I thought, well, I should try to do a graph, but it'd just be sort of a one single line going from north to south, and that wouldn't be very uplifting or interesting. So gone through some additional, I'm going to take a macro level and then try to tell you what's going on in some of the key states, and obviously I've got a pretty unique Illinois perspective. But prior to COVID and inside the first quarter, you did see A&E growth increase at about 8%, which was ahead of average from 19, and it still weathered a little bit of the storm in March, but we're certainly going to see those numbers decline as we move forward into Q2 and Q3. But overall, you just see a massive disruption here on the public side with highway trust fund receipts at the national level dropping by 79%. Highway miles traveled down by 40%. The Northeast getting hammered the most at nearly 47% decrease in travel. But nearly every region, inside the range there getting impacted, with the South Gulf being a little bit excluded from that. In terms of Illinois, we were a little bit held harmless through on the first quarter because, the way our motor fuel tax receipts come in, it's based on gallonage and by the wholesaler, and most of that occurs in the first couple weeks of the month. So in March we were okay, but then we did see precipitous declines, and we'll go over those here in a few. So what's the impact of COVID on state DOTs? And I think you can see the chart. It gives you there a bit of an example of what the traffic volume impact has been on some Chicago area expressways. Anywhere between 29 to 40% decrease. Stay-at-home orders have had a significant impact on this. Overall, AASHTO, which is the Association of State Transportation Highway Officials, is forecasting a 30% decline in transportation revenue over the next 18 months. You've had, at the beginning of COVID, you had some states immediately suspend construction operations and a lot of design as well that wasn't sort of safety or critical. Those have begun to come back online, but now you're seeing states really struggle with the impact to their budget. So states like North Carolina, Ohio, Missouri, and I'm sure a host of others are postponing projects and or canceling projects at this point because they simply don't have the funds right now to fund it, and this is magnifying as well because they're also losing the federal match for a lot of these projects. In Illinois, it's a bit of for once, Illinois is sort of the outlier on the good side. Generally, we get hammered for being one of the most in debt states, but in this instance, we passed a capital bill last year. So our roadway organizations, specifically IDOT, they are continuing with their program. They had a $33 billion capital bill that was approved last year and is being executed, and they are operating along those lines. It's a 6-year program, and I think their belief at this point in time is, they were held harmless in March. They saw about a 25% decrease in MFT in April, which I think sort of beat their estimates and wasn't as bad as they had hoped. There's still waiting for May numbers to come in, but I think the hope is that they can blend in those losses over the course of the 6 years and still operate it as need be. So in terms of their design schedule, it has remained unchanged, and their construction lettings are continuing as planned. But local roads are a different issue, and we'll touch on that in a little bit. So, but on the plus side, there was a traffic report yesterday which announced delays on the Kennedy. So perhaps we're slowly getting back to normal in the Chicagoland area. Looking at tollways, again at the macro level, there's 128 toll facilities covering 6,300 miles of road. They generate about $20 billion annually in revenue, and they're facing the same challenges as DOTs. Substantial loss of revenue. The Illinois tollway, itself is down 73 million in revenue for the first quarter, and it's harder for them to make it up because you're just limited by options, and also a lot of them aren't on 8 or 9 year capital spend programs. So IBTTA, which is the association that represents tolls, is forecasting a 50 to 90% decline in traffic revenue on tolls, and there's just limited options for tollways to begin to make this up. Bond covenants require bondholders to be paid first, and a lot of them have kind of strict regulations on how toll authorities have to make up shortfalls. So whereas some DOTs can hope to ride it out over a couple of years, tollways are generally in a little bit of a different position. Now, with that said, Illinois Tollway, much like IDOT, is continuing as planned. So they've maintained their current PSB schedule, which is for design programs, and their letting schedule is continuing as well. Again, with the hope that you might see a huge bump here in the summer as restrictions ease and travel increases. One of the largest areas hit right now are counties and cities. So counties are anticipating a $144 billion impact through 2021. The cities are estimating a $360 billion impact through 2022. By and large, you're seeing sales tax and other sort of local tax receipts down by about 30%, and that's not even hitting sort of those tangential areas of, whether you're going to see reduced property, reduced home values, which would reduce property taxes and such. So, permitting fees for opening businesses, other things like that. Some counties and cities have income taxes that are going to be impacted. So there's a whole host of collateral impacts that are going to occur at the counties and cities. But right off the bat, for the last couple of months, you've seen on average about a 30% decrease in sales tax, and that's obviously putting a constriction on their budget. And in many instances, counties and cities are delaying capital programs, postponing them, or outright canceling them, just because they have to make up for additional expenditures in healthcare now inside the law enforcement sector. So there's a lot of challenges happening in counties and cities. Many of them did get initial relief through the first CARES Act, but those funds were only used to offset COVID-related expenses, and they're going to be seeking additional assistance here with greater flexibility to use more relief funds. And looking at mass transit, I mean, I don't think this is a surprise to anybody on this call, but you're just seeing, tectonic shifts here in how people approach mass transit. Subway ridership in New York's down 75%, BART's down 94%. Here in Illinois, our Metro rail service is down 97%. Nationally, public transit is down 75%. Now, transit did see a substantial amount of relief in the initial CARES Act. For many of these entities, they may see their operations carried through the end of the year, but where it goes after January 1 is really unclear, and I'm not sure anyone has the answer to that, and I know I don't. So you're seeing not only, at least inside Illinois, you've got the RTA, which oversees Metra and other entities. They're funded both through fares and a sales tax. So when you don't have fares coming in and your sales tax is plummeting, it just puts you in a really challenging spot. So the initial CARES package will be helpful, but it's not going to answer the long-term questions. And I think then you've just got some psychological barriers also on the mass transit side. So what are all these associations seeking? So state DOTs, AASHTO has a request in for $50 billion that would go directly to state ODs to offset construction and offset revenue loss for transportation. Tollways, the IBTTA is requesting $9.2 billion for toll facilities to offset revenue loss. For cities and counties, National League of Cities has requested $500 billion in direct aid, and the National Association of Counties has supported $187.5 billion in aid. And in mass transit, APTA has requested an additional $23.8 billion in aid on top of the $25 billion they received in the initial CARES Act. And this isn't even covering some of the other sectors too, like vertical and airports. So, and in speaking about vertical specifically in Illinois, vertical through our Capital Development Board received a substantial part of the Rebuild Illinois funding, but it was contingent on gaming revenues in the creation of sports wagering in Illinois. Well, our casinos are closed and there's no sports, so there hasn't been really a whole lot of revenue going into the $10 billion in vertical projects for for the state. So that's really kind of a held up portion. On the airport side, Chicago Department of Aviation, which oversees both O'Hare and Midway, is continuing on with their modernization programs right now, but I know they're seeking additional federal aid that was initially in the on top of what was initially in the CARES Act. So what's coming, and what relief can people expect? So last month, the House, along a party line vote, passed H.R. 6800. This was a $3 trillion relief bill, which provided $500 billion in state aid, provided $15 billion to state DOTs. That's $35 billion less than what AASHTO was requesting. $375 billion to local governments, $75 billion to FAA, and $15.75 billion to mass transit. So this is on top of the nearly $2 trillion that has already been dispersed from the feds for COVID aid. This has, like I said, this moved out of the House on a party line vote, and it's currently in the Senate. There has not been a huge embrace by the Senate to take up this measure. Senate President has indicated that he felt it's too large. But there are some things that are emerging, and there's deadlines that will probably cause some action. So at the end of July, programs that were initiated under the first CARES Act, like the enhanced unemployment insurance, will expire. So the Senate is set to reconvene now on July 21st, and they will probably have to take some action regarding COVID relief to keep those programs up and running, and then also perhaps take action on some of the goals outlined in this bill. And I think, obviously the question is going to be, is the next phase going to begin discussing recovery versus relief? And I think, a recovery program would take a much deeper look at infrastructure and probably prioritize infrastructure spending. And one thing that Senate Republicans did articulate is that they were much more in line to favor line items for state DOT spending as opposed to just providing it to the states. They thought they would get some greater accountability from providing it directly to the Departments of Transportation. And then, kind of on the so there's a possibility to get some aid out of that program. And then last week, the House Transportation and Infrastructure Committee released an outline of a surface transportation reauthorization bill, which is a 5-year, $494 billion program. Would put $319 billion in federal aid highway, $105 billion for transit, $60 billion for rail, and $5.3 billion for highway safety. So this is a little bit pared down from the outline that they produced in earlier January, but this is it was good timing, and it's a good starting point for this conversation. There is renewed interest across both parties here to do an infrastructure bill. And keep in mind, the hang up has always been how do you do, an infrastructure with, with what funding sources. And I think what we're learning here is we've done $2 trillion of COVID relief without any dedicated funding source, and this would be a quarter of that program. So there are conversations going on about passing a reauthorization bill without a dedicated funding source and kind of picking up the funding source next year when we have to reauthorize the FAST Act or something along those lines. But both Senate and House negotiators agree that infrastructure is critical to recovery. It's timely because we do have to reauthorize the FAST Act. So we could see some movement on this in the coming months. So I'm providing the sunny side up there at the very end that we could see some federal action. So that's all I have, Bill. Back to you. Thank you.
Thank you, Kevin. And now I'd like to moderate the questions coming in from the audience, as well as some of the ones I've prepared myself for the panel. It's 1:53 in Central Time right now. We're not going to stop right at 2. We can go a little bit past that, from what I understand from Al. So I'm going to ask a couple questions here, really thinking about the structural engineers who are on the call, the 350 or so of them that have been listening here. The first question for the panel is, in previous downturns, many structural engineers left the industry, sometimes for good, or they changed companies during such downturns. Do you think this will happen again? And is now a good time to be leaving the engineering or the bigger AEC industry, or even considering changing companies?
Bill, this is John Cross. That's certainly a difficult question, and in terms of changing companies, we certainly saw less movement between companies during the Great Recession. It's obviously a very much an individual decision. In terms of leaving the industry completely, design and construction is cyclical. And if you're going to be in the design construction industry, you have to anticipate what those cycles will be and be prepared to ride them out and to a certain extent enjoy the ride. If you don't like cycles, well, then maybe you shouldn't be in the design construction industry. But it will come back, and I think we can be positive about that and move forward.
Yeah, this is Andrew. I would echo John's comments. The cyclicality of it is one of those pieces. Is the cycle going to be as long as it was back in 08, 09? I don't expect that it will be. Thinking back to the slides that John had, his kind of realist in terms of when is GDP back? When is employment back? From a GDP perspective, I know my best estimate right now, our team as we look at it, is looking for kind of the end of 2021. Q4, I think John had Q3 as kind of the realist. We're just a little bit behind that. On the employment side, as a nation, we're looking at, from our standpoint, probably in 2024 is about when we get back to that 4 to 5% employment that we were at before, or the unemployment kind of getting all the jobs back. But it's also been concentrated in specific industries. So, depending on what type of firm you work with and the areas that you focus on, some of the areas, particularly from an employment standpoint, that have been heaviest hit have been areas like restaurants and bars. They, of the roughly 21 million jobs lost, 5.5 million of those were on the restaurant side. And those were also some of the quickest to come back, over 1 million that came back when we got some of the data on what happened in May. And I think we're going to see some shifts, but I think the demand is going to continue to be there. As we emerge from this, some of what we're building and where we're allocating those resources may shift kind of in the near term. But one of the things that I think we've seen kind of going into this year, let's step back even before COVID-19 went into effect. There was some back in 2019 and 2018, there was this focus on what was happening with the China trade tensions and the relationships that we had on the manufacturing side with nations around the world. And one of the things that we saw throughout 2019 from an economic perspective is a reallocation and positioning of where our supply chains are. And some of that was coming back here to the United States. I think we are going to see some more of that activity as we emerge from this, particularly on the pharmaceutical side, some core sectors. Some of it's moving to other countries we have improved relationships with. Tech is moving to South Korea and Taiwan, hard goods. Some of that was taking place over in the UK and France rather than in China, soft goods in Vietnam. But I do think we're also going to see that as kind of a contributing factor over the next 1, 2, 3 years, that we're going to have some of that inflow and activity as we look at some of these core sectors and making sure that we have that comfort in supply chains and logistics, again, so that if we run into an issue with these types of things in the future, that we don't see a downturn of this magnitude if and when that arises.
Thanks, John and Andrew. Another question. This has to do with big cities and living and working in big cities. Certainly during COVID, the big city was one of the last places you wanted to be. And recently with the civil unrest and the rioting, the big cities were about the last place you wanted to be. A lot of engineers have already moved out of big cities. And this has been spurred on in the last few months by our ability to work remotely, which many of us believe has far exceeded our capability of what we ever thought we could do. But now many are working remotely, and the need to be in the big city is not as strong as before. And even as recently as yesterday, SDAOI announced that their Chicago office will let their lease expire at the end of June and not take an office lease for the next year and consider that. So what do you think the impact will be on the cities and on the structural engineering community that works in them?
Yeah, that's a great question. This is Andrew again. One of the things that we've seen historically is we've looked at that movement into and out of cities, and that movement out to the suburbs is some of the age-related movements that are related to that. The younger generations, those coming out of school, tend to like the urban environment. When you're single, when you don't have kids, when you don't have a dog, you don't mind as much not having a yard. You just want to be close to things, close to activity. And while some of that may change, we've seen things, if we think back to what happened in 9/11, there's very real emotional fears, and people think about, where are they at and where do they ultimately want to be. But we see, it's not something I see really, fully going away. I do think we are going to see a bit of a shift towards some more remote work, which would allow for, again, more of that movement out into the suburbs. But that said, if I look at what I've seen, in some of the industries that we focus on generally, tech is one of the industries where they've allowed for more work remotely, but people are social beings. People are social beings, and even before we got into, again, this COVID situation, if we look back at prior examples of some large companies that allowed for remote work, people embraced it early on, and it got a lot of attention, and people would start to do it, but then they said, you know what, maybe I don't want to be working remotely all the time. I want to be working remotely for 1 day a week or 2 days a week, because I still want to see my teams. I still want to work with my people. There's something about that personal side of it that I think is difficult to replace. Does it change the way the office looks? I know John in the past has commented, and his research, if you don't watch his commentary, he provides fantastic commentary, and I know our team looks and follows his comments as he looks out on the industry. But there's been talks about, are we going to see larger workspaces, larger desk spaces, for things like preventing the spread? So that may be somewhat of an offsetting impact. You may have fewer workers in there, but more space needed per individual worker. And if we do see a shift out into the suburbs, which I think we will see some of that with the older demographics and with family formations, it's going to increase the need for some of the types of facilities, whether that's construction on restaurants or libraries or the things that kind of really build a community. It looks a little different than it does downtown, but I think that demand is going to be there.
And I would agree with what Andrew's saying. After 9/11, there was a lot of talk about individuals moving out of the New York City metropolitan area there because of security concerns. That concern lasted about 6 months and it didn't stick. I think on this one, we're going to have to see at the end of the pandemic, wait about 6 months and then start to look at what the trend actually is at that point.
Yeah. Very good. There's a question about, and this is probably a good one for you to start off on, John. In previous recessions, which structural engineering firms came out of or rebounded from those recessions the best? And can you anticipate similar such rebounds now?
I think the ones that came out the best were the ones that invested in new technology, could optimize what they were doing. They were also the firms that had continued good relationships and monitoring of projects that they had worked on in the past and firms that they had worked with, so that if there was a rehab or renovation project, the natural place to go would be back to the firm that did the original design, and they knew who to go to in that firm. Relationships are keys during these times. Niche expertise is key, and using the tools that can make you the most productive certainly is very important during this kind of a period.
There was another question about construction activity and being able to respond in light of the COVID and social distancing requirements, some of which has happened. In Chicago, construction never stopped. In cities like Boston, the construction did stop. Do you have any thoughts about future construction issues following this pandemic?
Yeah, this is Kevin. I guess I'll start on this. And there were certainly challenges on the vertical side. Capital Development Board in Illinois, CHA, other entities did put some halts to projects because they just couldn't reach the social distancing requirements that were outlined or expected. But I think overall, industry's done a really good job of kind of self-policing ourselves and creating best practices, informing clients, and walking through with policymakers and agencies on how we're going to approach safety and social distancing and PPE and all of those things. So there's a level of confidence with our clients that they knew we had a plan and we had a foresight and that we would make sure that employees were safe. Only in a few instances in this region did I hear about sites being shut down in the event that someone tested positive or something, and in those instances they did a good job of remediating the site, taking care of the employee and getting the project up and running. But I think overall industry, I think, set the standard here by creating policies and guidelines and then articulating those to the clients.
I think too, one thing that we've seen, whether it's construction or other industries, is as we know, information travels faster than ever right now, and that holds true for good news and bad news. When it's bad news, if you think back, the pace that we were inundated with information as COVID, as the coronavirus was growing internationally and then here in the United States, it can be overwhelming at times. and we kind of lived through this social media virus that impacted the way we were viewing the world around us. But those same tools, that same technology that allowed that information to travel quickly is also allowing information to travel on the positive side and developments across industries and across the world, really. And I think one of the things that I've watched that to me has been little short of incredible or miraculous is the pace at which as companies adapt, as industries adapt, as sectors and countries adapt, that information on what is working and what's not working is spreading globally. And so right now there are certain areas, whether that's restaurants, and restaurants, they started to reopen. They're in a concentrated area. The customers are at risk of infection, and they have to consider the liability related with that. And so what we started to see was conversations taking place across the country on what was working and what wasn't, and where creative ideas. And we started seeing, one city would shut down a street and say, hey, we're shutting down a side street off Main Street, and we're going to do outdoor seating. And they saw this boom in activity because people really wanted to get out. I think we're going to continue to see progress, and we're going to see creative solutions coming not just from the restaurants and bars, but in the construction industry and a lot of these industries. Everybody wants to kind of get back to work, to get back towards activity, but to do it safely. And as certain companies or states figure out ways that's working where they're seeing the positive results without a pickup in cases or concerns over the health risk to it, I think that progress and those new ideas are going to spread across the country. And I think we're going to see some interesting developments over the next few weeks and months. It may look a little bit different from how we were working before, how many people are working on a site, how we're spreading them out, how we're doing certain processes. But the U.S., the world, we get incredibly innovative when our backs are against the wall, when we're forced into a situation where we need to do something new. We have a history of figuring out how to do it.
Thanks, Andrew. And John and Kevin as well. So I've lost my internet connection, and I can't see any of the screen anymore. Luckily, I called in on my phone for this, and I'm anxious to get back to the office for all these types of reasons myself. But I guess what I should do now, it's 2:09 in Chicago. I think, Al, if you could pick up from here, if there's any remaining questions that you can see that you'd like to ask of the panel, if you could do it, or otherwise wind us down here in this session.
Yep, Bill. I will start winding down now because we are after the hour, and I want to make sure we respect everyone's time. Thank you to all of our speakers for this wonderful session today. On behalf of NCSEA and the Structural Engineers Association of Illinois, I want to thank everybody for their attendance. This session was recorded, and it will be placed on the NCSEA website after the recording has been processed. Thank you again to the speakers for their wonderful knowledge, and thanks to you attendees for your participation today. Good luck as we move forward throughout this COVID pandemic. Thank you.